How's everyone doing? Welcome to the Strategy Room. You are here with the banker next door, your host, Dr. Joe Berquist, on this Saturday, February 7th, 2026. This is a little strange. I'm usually on at nighttime. Usually I do this show around 8 o'clock. Unfortunately, my scheduling this weekend was such that I had to go to a different time and I had to try something a little different. I don't think I've ever been on in the afternoon, in an afternoon time slot in the little over a year that I've been doing this live stream. So this will be interesting. We'll see how this goes. But I have the total usual show will be 2 hours, a little over 2 hours here. We'll see how that goes. We got a lot to talk about here. An incredible amount happened this week, an absolutely roller coaster ride on Wall Street as we saw crypto blowing up. We saw gold and silver blowing up. We saw potentially the AI trade blowing up. So a lot of, but then Wall Street bounced back yesterday on Friday in a big way to close over or at least the Dow to close over 50,000 for the first time. And we're going to take a look at all that. We're going to take a look at where interest rates are right now. I've got a lot of new tariff news that came out this week. We've got some economic indicators, some very big banking merger announcements this week, as well as the merger between SpaceX and XAI. So we're going to talk about that a little bit. We also got a little bit of Jeffrey Epstein news to talk about and how that is impacting some players in the business world and how that could potentially become a bigger thing. And then finally, if I have time to get to it at the end, we have just a little bit of labor market news to talk about. You know, what's going on with some of the labor market issues at the moment. So we'll take a look at a little bit of that stuff. But as always, I am going to kick us off here. We're taking a look at the U.S. debt clock, and I like to show. I always like to give the reminder, show some of these numbers on here. So the U.S. national debt still cruising at $38.7 trillion. Debt per U.S. citizen is $112,842. The debt per taxpayer is $355,811. Think about that for a minute. U.S. federal spending is still a little over $7 trillion, with the U.S. federal budget deficit still coming in at $1.7 trillion. Now, I always like to point out that the Trump administration has been able to at least make a dent in the federal budget deficit. It was about $2,070,000,000,000, like something in there. So they have been able to bring it down 300 billion or so. So they have been able to make a little dent in it, but still, yeah, long way to go to balance that budget. Tariff revenue still at $373 billion, revenue per taxpayer at 3,247. The debt to GDP still cruising it at 124%. What else do we got here? Defense spending still at $928 billion. Interest on the national debt is at $988 billion, so almost coming up to the $1 trillion mark. And then I want to point out a couple of interesting things that they added on here. So they have DeFi, decentralized finance, so the DeFi bankless future. And I'd be really curious. I haven't had a chance to investigate like where they're getting some of these numbers at, but they have the U.S. federal interest savings per year at $988 billion. And savings per adult, 9,121, and the U.S. total interest savings per year at over 4.9 trillion, and savings per adult 40,898. Those are some pretty wild, numbers on there. So that'd be interesting. Money creation. They have the future U.S. Treasury dollars, 1.7 trillion. U.S. M2 money supply as of right now, $22 trillion. This is the eye-popping stat, right? Currency and credit derivatives, $862 trillion in credit derivatives. Yes, I do. I cover the report from time to time on annual bank derivatives. I actually have that. I haven't been able to get to it, but I hopefully will get to that one here in the next week or so. When I get to report week and just cover a lot of the banking reports and stuff that are out there. U.S. debt held by foreign countries, $9.3 trillion. U.S. trade deficit, $848 billion. U.S. trade deficit with China, $125 billion. So again, just some very, very interesting numbers to look at here. I think it's great to look at some of these things because it really puts everything in context when you understand all of these numbers. So, and then we go into, let's take a look at interest rates here for a few minutes. So the 10-year T-note, where is the 10-year T-note? Is it 4.217%? Not really all that much changed from last week. Everything pretty much holding about the same. The 30-year bond is at 4.8%. 5 years at 3.75. The 2 years at 3.5. 1 year 3.4, 6 month at 3.62. So haven't seen much of a change on this. I think what is a little worrisome is that this, the notes, I would personally like to say, again, I think the goal here was to get this back, keep this around 4%, and hopefully get this back under 4%, maybe somewhere in the neighborhood of like 3.75 to 4%. So it's a little troubling that this has jumped up the way it has to 3.2%, and it's just been kind of sitting there the last few weeks. So we'll keep an eye on that one. But the interesting thing here is that this has not had a bad effect on the again, I've said it a million times, the 10-year treasury rate. Why do I always harp on that? Because that is the rate that drives everything on, especially on the consumer side of things. The 30-year mortgage, your credit card rates, it's all ties into the 10-year T-bill in one way, shape, or form. Auto loans, student loans, everything like that. That 10-year rate is so important to everything that we do. But the 10-year rate going up to 4.2% hasn't really had that big of an impact on the 30-year mortgage. As a matter of fact, 30-year mortgage has actually come down. So let's take a look at this from Yahoo Finance here for a second. So the average 30-year fixed mortgage rate had ticked below 6% earlier this week, but it's since dropped back down. According to Zillow, the current 30-year fixed rate is 5.95%. You may qualify for an even lower rate if you qualify for a government-backed mortgage. For example, today's average rate on a 30-year VA loan is just 5.48%. When shopping for a mortgage lender, ask them to help you compare different types of mortgages so you can find the best deal. No, that's not a sponsor. I don't get any money or time slot for that. I wish I did. That'd be nice. But again, just looking at these mortgage rates here for a second. So 30-year fixed rate at 5.95%, the 15-year fixed rate at 5.43%, a 5/1 ARM is at 5.93%, the 30-year VA, again, 5.48%, and the 15-year VA at 5.18%. So this is great. So we've actually gotten the mortgage rates now down into the fives. So we've broken through that 6% barrier. And while it's still very high fives at 9.5 or 5.95%. Still, again, it's great that it is absolutely going in the direction that we wanted it, and we're hoping that it was going to go. So this is very good news here on the mortgage front. So I wanted to share that with everybody on rates. Now, obviously, I'm going to run through a bunch of articles here, just kind of giving the big news of the week and just letting everybody know what was going on. So obviously, we had this partial shutdown, this kind of weird shutdown thing, but Trump did, the House did get a bill through. Trump signed it to basically end this partial shutdown. Now, basically, all that's going to happen is, the Congress is going to go, they're going to go argue about negotiating funding for DHS over the next couple of weeks. But nothing really major or significant is going to happen here. This certainly is not anywhere near as bad as the shutdown that we had just seen back in October and November. So this is just kind of a little blip on the on the screen, so to speak. But like I said, whatever potential there was for a bigger shutdown, that all got taken care of earlier this week. The reason why I wanted to point this out was because this did have an effect on the market early in the week. I think that the market was very nervous about, oh my gosh, could this be prolonged? Could it become a bigger thing than what we're used to? So again, I think this did have a little bit of an effect on the market, not as much as all these other things that we're about to talk about, but it did. And then I just wanted to report on this. So Stephen Miran actually resigned from his White House post this week. So Federal Reserve Governor Stephen Miran is leaving his post as chair of the Council of Economic Advisors, CNBC first confirmed. He joined the CEA in January of 2025, but had been on leave from that post since last September when he filled the unexpired term of former Fed Governor Adriana Kugler. Miran's term at the Fed did expire on January 31st, though he has continued to serve pending a replacement. During his time at the central bank, he has championed aggressive interest rate cuts. So this is interesting because I thought what was going to happen was I thought Stephen was going to kind of finish out his term here, and then I thought he was going to go back to the Council of Economic Advisors for the White House. I thought that was kind of the plan here. So it is interesting because Kevin Warsh was named as the next chair of the Federal Reserve. So is Kevin going to take his spot on the Federal Reserve Board and then get appointed to be chairman? I don't know yet. This, like I said, this has added kind of an interesting wrinkle here. I'm sure that Stephen would probably like to stay on the Fed board. I think the White House would probably like him to stay on the Fed board, but I don't know if there is a spot there for him. I don't know if there's some way that would work out. The Fed does have a couple other people retiring in May, but there's a little bit of, there's almost like a 3-month gap there. So I don't know exactly how that would work or how that would play out. But like I said, this was big news. I just wanted to put it out there just to cover it. And my thought is, as whatever's going to play out, as it becomes more clear in the next couple of weeks, I will bring that back and talk to everybody about that. So, but obviously, the big news from yesterday, the Dow hitting 50,000 for the first time ever. The stock market is rallying following 3 days of selling amid tech stock, metals, and crypto turmoil. It almost seemed like everything was melting down at the same time this week. It was pretty wild. But I just wanted to take a minute and kind of look at this and put this in context. I mean, the Dow hitting 50,000, it's incredible. I'm not that old, but I'm in my mid 40s, and I can remember, being in high school, being in college, and I remember the Dow hitting, 8,000, 9,000 for the first time, the Dow hitting 10,000 for the first time. I can remember the Dow hitting an all-time high of a little over 14,000. And then during the financial crisis in 06, 07, and then dropping back, and then not being able to find its way back to 14,000 for a number of years. It's just pretty wild. I can remember in college when again, being a finance and economics major in college and going back and just studying, you had to study a lot of the history of the market. And then over the years, I've read a lot about a lot of different stock market crashes, panics, a lot of monetary history in the United States. And it's just kind of wild. I mean, you go back to the 50s and 60s, which in a certain regard really weren't that long ago, and you see the Dow hits 1,000, Dow's at 1,500 points. I mean, so it's just wild to see, how far this has come. But it also reminds you too of the inflation issue since 1971, when President Nixon took us off the gold standard, and you see our debt explode to 38 trillion, and you also see the Dow explode up to 50,000 over that time. So you see the effects of asset price inflation and what it does. So. But again, I just wanted to take a minute to recognize this, because I mean, this is a moment, and it's a very interesting moment that we hit 50,000 for the first time. I mean, it's pretty remarkable. So, and I can assure you, if we've hit 50,000, the next stop is 75,000, 100,000. Like, yeah, it will happen someday. It will happen someday, and it's pretty wild to see. So. Now, that being said, it seemed like everything was going the wrong way in the market this week. So we have people here calling, is this a new crypto winter? Right now, with the drop in Bitcoin and crypto this week, we also had the software route is spreading pain to the debt market. So now all the software companies are under fire because of AI. Basically, a lot of them saying, "Oh my gosh, AI is going to destroy these software companies. They're not going to be needed or needed as much." That was one of the things. Obviously, private market AI panic. When recurring revenue isn't, investors are turning skeptical of private equity and loans promised on supposedly predictable results. Then we got into the week Anthropic tanked the market and pulled ahead of its rivals. Once a distant second or third in the AI race, the company is moving to the front with a focus on caution, coding, and business clients. So again, Anthropic really taking a leap this week as everybody else was blowing up. And then obviously you had the meltdown in the gold and silver market. Most of that meltdown actually occurred last week, going back to last Friday. But an investor's guide to the boom and bust in gold and silver. Friday's plummet in precious metal prices shows the danger of being late to a rally that has gone far beyond reality. And then the silver market is messed up. These buyers are feeling the pain. Boom in precious metal interrupted by Friday's plunge-fueled frenzy among refiners and caused major pain for companies that need the stuff. So again, very, very interesting week. So let's go back and go through a couple of these things one by one here. So a new crypto winner is here, and even the biggest bulls aren't certain why. So some of crypto's biggest champions can't put their figures on what went wrong. So Bitcoin just suffered its largest weekly decline in more than 3 years. But the worst part for some of crypto's permabulls is that they aren't sure what exactly caused the crash. The sell-off left many of the market's luminaries, those so well known that they go simply as Pomp and Nova and Mooch, searching for answers. Bitcoin is crashing and investors are freaking out. Anthony Pompliano, a crypto evangelist and investor, wrote Friday, Bitcoin fell 16% to 70,000 this past week. It actually dropped below 70,000, down a sharp 45% from its all-time high of 126,000 in October. Ether dropped 24% to $2,052, off 59% from its own high of last year. Both tokens staged furious rallies Friday, but the week remained a historically bad one for crypto, and few seem to know what went wrong. Market theories for the sell-off range from investors' pivot toward the prediction markets and other risky bets to widespread profit taking after a blistering bull run. So you can see here from this chart, March of 2024, crypto was around 44,000 and President Trump gets elected. A lot of positive crypto vibes. It goes up to 76,000 when Trump was elected. And then we get the Genius Act goes into law. It's up to 118,000. It hits its all-time high. Trump's surprise announcement of 100% tariffs on China. And then woof, it is down, baby. 63,000 here. Was where it was at here as of February 5th. And then it bounced back and then it says, and then they go on to say here, there was no smoking gun. For much of the last year, crypto was in abscendance. President Trump's return to the White House ushered in a new era for digital assets, which continued to gain acceptance among individual investors and legitimacy on Wall Street. As Bitcoin and other popular tokens touched record highs, it seems as though the market's best days always lay ahead. I really didn't think that we'd see a 6 at the beginning of the Bitcoin price ever again, said Corey Clipston, chief executive officer of the Bitcoin financial services firm Swan Bitcoin. And yet for a 24-hour stretch that ended Friday afternoon, Bitcoin was back at that level. Past crypto sell-offs had clearer explanations, which made this one more mystifying. In 2018, Bitcoin fell 80% from its peak after the initial coin offering bubble burst, ending an era in which thousands of unproven startups raised billions of dollars with little more than a sales pitch. In 2022, the $40 billion collapse of Terra USD and Luna coins triggered a cascade of company failures across the crypto sector that culminated in the implosion of Sam Bankman-Fried's FTX exchange. This time, there is no clear consensus. If you ask 5 experts, though, you'll get 5 explanations, said Anthony Scaramucci. We're not listening to anything Anthony Scaramucci has to say. And then it goes into a couple things like new shiny objects, more supply, new sheriff, clouded clarity, profit taking. So again, and I think it's actually again, for whatever my 2 cents is worth, I think that it was actually a combination of a number of things. I think profit taking was a huge thing, at least at first. I think one of the biggest things is the cloud around the crypto legislation. Like, in other words, I've talked a lot about the 3 crypto bills that are out there. You have the Genius Act, which was passed into law. That got through Congress, got through the Senate, signed by President Trump, signed into law. But they went through the open comments period, and now they're going through all the rulemaking with that law. And that, so again, that hasn't officially been rolled out to anybody yet. But then you also have the Clarity Act and you have the Anti-CBDC Act. Now, both of those bills were passed by the House, and they're both sitting in the Senate, and they've both been kind of stalled in the Senate. What is very interesting is that I think the most important one is the Anti-CBDC Act, because that would basically prevent the Federal Reserve from ever creating a central bank digital currency. Will the Senate vote on that? I don't know. I mean, that bill has almost like disappeared. You haven't heard nothing about that bill since the minute it got passed by the House. So that is a little concerning. But what has happened with the Clarity Act are a couple of things. Number one, they originally, you've got kind of the CFTC and the SEC kind of not really fighting, but going back and forth over who ultimately is going to be in charge of crypto, and who is going to be in charge of different facets of crypto, whether it's the cryptocurrencies or the stable coins or the investment funds like ETFs and things like that. Who is going to have control over all of that at the end of the day? That's kind of the one issue. The other major issue is, what are the rewards that stable coins would be allowed to offer? Like right now, banks absolutely, they do not want stable coins to be able to offer any rewards of any kind, because they don't want stable coins to have a negative effect on bank deposits. That's the real major concern right now. And the Treasury freely admits this. I covered in one of my other episodes that I did early last year, in about the end of March, beginning of April last year, the Treasury came out with a massive report that basically said, in the report, I went through the whole thing and basically said in a nutshell that yes, if stable coins go through and there becomes this mass embrace, if you will, of stable coin, and a lot of people start buying it and holding it, that will have a very negative effect on bank deposits, and bank deposits could drop by as much as 30%. Now, you may ask, well, why is that such a big deal? Well, it's a major deal because it could send major ripple effects through the economy. In other words, deposits are the lifeblood of every bank out there. If banks don't have deposits, they're not able to lend money. So if they can't grow their deposit base, they're not going to be able to grow their lending. They're not going to be able to lend people money. And you might actually see it. And then if deposits start to go the other way, if they start to shrink, you could actually see banks out there saying, hey, we can't lend money right now. We're going to have to shrink our balance sheet. And not only that, we will still be able to lend money, but we're going to have to be uber picky about who we lend money to and when we lend that money to them. That obviously, the economy, would have massive problems at that point, because, in other words, like everything has ripple effects, right? Like the bank lends money for this company over here to open a brew pub, right? And then the brew pub needs to hire a whole bunch of other companies in the local market. They need to hire marketing and signage people, and they need to hire an accountant and a lawyer and a payroll company, and they have to hire employees. And then the money that they get from running their business, they pay their employees, and their employees go out and shop at other businesses. It's just it's that economic effect of rolling out. So if those loans aren't there to fund those businesses, and then the businesses aren't there to hire the employees, and so you see how the ripple effects then begin. So again, but that's the big thing going on with crypto right now. It's the massive fight over the Clarity Act, and I think that has put a big cloud over what's going on in crypto, and I think that's the major reason why. And again, because people in the crypto world view what is about to happen through this legislation is going to be very negative. In other words, the crypto bros are not going to get what they want out of this Clarity Act. The Clarity Act is going to end up favoring banks at the end of the day, whether they like it or not. And because of that negative sentiment, that is one of the big things that is driving crypto down. So hopefully that helps. Now, I will say this. I do not usually spend a lot of time covering crypto in the live stream because I have I do a whole other side series called the Crypto Series. If anybody get a chance, next week, I did a whole coverage on Tether and their involvement in Venezuela and Iran, which I thought was really fascinating and kind of showed both the pros and the cons, the good and the bad, if you will, of stablecoin and crypto and how it can work for good, but it can also work for bad. So again, very interesting story there, as just well as other crypto news that I had in that episode. Now, like I said, I'll talk about that a little bit later in the live stream when I get to the episodes that I put out for last week. But I will have another crypto episode coming out this week where I will talk more in depth about all this, and I'll get into all that. So keep an eye out for that this week as we move forward. So crypto market in the tank, but now let's get into the overall, more of the general market and the AI market, if you will. So the software route is spreading pain to the debt market. So tech sector had an outsized presence in loan portfolios, raising risk of contagion. Now, Click here, this is a software company. This is actually not too far from me. They're actually headquartered in King of Prussia, Pennsylvania, which, if anybody knows, the world famous King of Prussia Mall, which goes back and forth with Mall of America as the largest mall in the United States. I think King of Prussia might have that title at the moment, but they go back and forth. They build additions every 5 minutes onto these buildings, and so they've constantly been batting. But Click is literally like 2 minutes from the King of Prussia Mall and their headquarters. So I know this is a company I know very well. But the steep sell-off in software stocks is spreading to the debt market, pressured by growing worries about the disruptive potential of new AI coding tools. Shares of large software companies such as Salesforce and ServiceNow have been sliding for months, but now the prices of software company bonds and loans are also dropping. That expanding pain is worrying many on Wall Street because software has come to assume an outsized presence in the corporate debt market, the result of a wave of private equity buyouts that stretched from the late 2010s through the early 2020s. A downturn in this sector has the potential to drag down other areas of the market, cooling what has been a humming credit engine. Software currently makes up 13% of the Morningstar LSTA US Leveraged Loan Index, which tracks speculative grade loans that are originated by banks and broadly distributed to investors, more than double the share of the next largest sector. The sector makes up an even larger percentage of private credit loans, private credit market, made by asset managers directly to companies, with estimates putting the share at around 20% to a third of those loans. Since mid-January, the price of loans issued by the likes of Cloudera, a data analytics company, and Click, the maker of business intelligence software, have sunk by around 10 cents on the dollar or more, according to S&P Global. Overall, the average price of software company loans in the Morningstar LSTA index has dropped to $90.51 on the dollar as of Wednesday. So again, you saw this big drop in the software companies, and again, they're under threat for AI, but this is also having an effect ultimately on the debt markets. And then we go to private markets AI panic when recurring revenue isn't. So investors are turning skeptical of private equity and loans premised on supposedly predictable results. So with fears erupting that software companies will be disrupted by artificial intelligence, investors in private asset managers are shooting first and asking questions later. Private investment firms have piled into the software industry in recent years. At the end of last year, almost 9% of private equity-backed companies were in the software space, according to PitchBook tracking. The exposure is even more significant on the loan side, with the private credit universe tracked by ratings firm KBRA. The firm classifies about 17% of borrowers as software companies, representing about 22% of the $1 trillion plus debt exposure in the universe overall. Like, in other words, in the private credit market, you have about $1.7 trillion in loans, in the private credit market, and they're saying that about 22% of that is made up of these loans here to software companies, which is rather fascinating. Private investors prize the recurring subscription revenue of companies that sell software over the cloud, in part because it lends itself naturally to leverage. Debt investors need more long-term clarity than equity investors because they want to be sure they will be paid back in future years. Loan funds are hungry for that paper to match their fundraising surge of recent years, and more leverage in turn enhances the return for equity investors. Nowadays, however, the core assumption of predictable revenue has come under fire. If these companies are going to be displaced by cheaper, better AI-powered tools, then in theory, customers might have enough incentive to go through the headache of canceling subscriptions, or at least demand a fee cut, right? So earlier this week, Anthropic's announcement of an AI tool for legal services was like a match tossed into a dry forest. Yes. So, and then we can see here from this chart, so private lending in the spotlight. We can see here Oaktree Specialty Lending, Ares Capital, Galabus, if I'm saying that right, Galabus Capital, which is a big company, BDC. You could see that they are all down here in the negative. So not good. So, and then this week, earnings reports by private asset companies, including managers Blue Owl Capital and KKR, and business development companies Ayers Capital, Globe Capital, BDC, and Oaktree Specialty Lending have been opportunities to explain why their software portfolios are insulated or are even set to benefit from AI disruption. Yeah, we'll see. We'll see about that. And again, I'll point out again, I just did an episode again this week that just came out. I did a private credit market update, hugely popular episode. A lot of people love these updates on the private credit stuff right now that I do. So if you get a chance, go check that episode out. But again, you see, I think the important thing to see here is how a lot of this stuff is interconnected. You know, the AI with the private credit, with the software companies, with the debt markets, you know, with the leverage that they have enacted. Obviously, the massive spend of AI companies on the infrastructure right now, on the data centers, on the power lines, the nuclear power facilities, the coal plants, all that. It all runs, this stuff is running together at the moment. And that's why you saw almost all of the markets, if you will, whether it was the market, the crypto market, gold and silver, them all kind of having a mini meltdown this week. And then we go to Anthropic. Like we just mentioned Anthropic a second ago. The weak Anthropic tanked the market and pulled ahead of its rivals. So once a distant second or third in the AI race, the company is moving to the front with a focus on caution, coding, and business clients. So Anthropic's recent product enhancements, including industry-specific add-ons and advanced models, caused a global stock sell-off across various sectors. Now, Anthropic, I believe, because they have their Claude product, like they are much more involved in what would be known as agentic AI. Like I just did, again, I keep saying that. I just did an episode on agentic AI and what it can mean for bankers and banking. So if you have any interest on that, you can go check out that episode. But again, two different types of AI. You have generative AI and then you have agentic AI. Now, very, very simply, what are the differences between the two? So generative AI is what you see when you're talking to chatbots, when images, any type of AI images, AI videos, that's all generative AI. Agentic AI is basically a bot that actually does something. Like agentic AI is what you would find in finance. Like if you wanted to automate or streamline some of the finance functions, like say in a bank or in a company, agentic AI, that's what you're looking for. That's what that's going to do. So that being said, just to add a little context there so people kind of get the gist of what it is that Anthropic is focusing on. So, but Anthropic once appeared as an also-ran in the chaotic race for AI supremacy. This week, the sophistication of the startup's products upended the stock market. A simple set of industry-specific add-ons to its Claude product, including one that performs legal services, triggered a days-long global stock sell-off from software to legal services, financial data, and real estate. Then Anthropic unveiled Super Bowl ads to taunt rival OpenAI. That was kind of funny. That's kind of a side note, but they based so the not to get off topic, but the thing there with that was that so OpenAI is going to start running advertisements, and obviously that's not going to make a lot of people happy. People don't want to see, they don't want to see ads messing in their AI. But Anthropic basically came out to troll them and basically said, yeah, we're not running any ads in our AI products. You're not going to see any of that in there. And they actually ran a Super Bowl commercial to point this out to everybody, which again I thought was kind of funny. But on Thursday, Anthropic unleashed its most advanced model yet, capable of synthesizing data and analysis, running teams of coding assistants and functions akin to product management. Shares of software companies, including Salesforce, Intuit, and others, fell again Thursday, although less precipitously than earlier in the week. The viral moment for Anthropic's models is the most important thing that's happened in AI since ChatGPT's launch, said Dean Ball, a senior fellow at the Foundation for American Innovation, who writes an artificial intelligence newsletter. It's infinitely interesting. I would agree with that. So, is this the biggest thing that's happened since the launch of ChatGPT? I don't know about all that. That seems a little blustery, right? But industry prognosticators and AI evangelists have spent months foretelling the toll Anthropic and other sophisticated AI tools would exact on software as a service companies that were darlings of the previous internet era. Tools made by such companies as Workday, Monday.com, and Adobe have become the digital backbone of much of corporate America. We could see here from this chart for this week, so the S&P 500, you see Adobe, Workday, Salesforce, Intuit, Monday.com, all taking a big drop this week. So Anthropic's tools, which include so-called agents that can act autonomously to carry out increasingly complex user requests for hours, have offered a preview of the threat sophisticated AI models pose to entire companies. The startup has found its way to the forefront of the AI conversation with a novel strategy focused on safety, software engineering, and business customers. The result, a broader business reckoning that has left corporate leaders asking what it will mean when an AI system can easily replicate expertise developed over a lifetime of coding, or in the case of companies, years of corporate development. Tech titans such as NVIDIA chief executive Jensen Huang and others have warned that the correction is an overreaction because many platforms are far more complex and intricate than spinning up simple websites and apps. Many companies also give priority to investing in their businesses rather than building internal software tools. Analysts have said, yeah, I think that Jensen is absolutely correct there in that assessment. I think this is a little bit of an overreaction. Look, this stuff it's going to change things. It's going to change companies, their models, how they work, how efficient they are. All that stuff is true. But is this just a knee-jerk reaction? I think it is. I think it is an overall reaction there. So, but again, it's just important to point out, again, for anybody sitting there wondering, hey, what happened in the market this week? Why did we have this meltdown and everything across the board? Well, this is why. This is what was happening. And now let's take a look at gold and silver for a minute here. So an investor's guide to the boom and bust in gold and silver. Friday's plummet in precious metals, shows the danger of being late to a rally that has gone far beyond reality. So what if, and bear with me here, the wild gyrations in gold and silver prices are actually telling us something? There are three plausible messages from the rise in gold prices. I'm not convinced that any of them provide a full explanation of what's going on, but all have a grain of truth and tell us something about how investors in stocks, bonds, and currencies are navigating a very uncertain time in the world. So number one, investors want gold as a dollar alternative. Yes, and again, this is an interesting chart here, just showing the plunge in silver, down 20.7% here. And the plunge in gold down 13%. So again, we saw a little bit of a bounce back this week, but again, still down. But number one, investors want gold and dollar alternative. Number two, the debasement trade. And then number three, the global boom ignites inflation. So, yeah, I mean, gold has always been a hedge against inflation. But I think the debasement trade, the idea that, an idea that appeals to a lot of those scared by the last bout of inflation is that another one is on the way, caused by hefty government stimulus and a deliberate policy of weakening the dollar. A weaker dollar is mechanically good for gold since it is priced in dollars, while gold is often touted as a safe asset to sit out inflation. Yeah, I do not see another major bout of inflation coming, and that is because the government would have to give further stimulus. And I'm still hoping and praying that our government will continue to reduce spending, that they will continue to cut spending in the years ahead, and that they will not continue to spend money like drunken sailors. So that will help with that. Also with trade, remember how much we've talked about trade and how I just covered the Federal Reserve Bank of San Francisco. They just did a study on tariffs that looked at 150 years of tariff history, and they came back with two very big things. The first one is that tariffs throughout the course of their history do not lead to inflation. They actually lead to deflation. Tariffs are actually deflationary. But number two, and this makes sense, tariffs also lead to an increase in unemployment. Now, why would that make sense? Well, if tariffs are in fact deflationary, that means that they decrease economic activity. And if you have a decrease in economic activity, that would also coincide with an increase in unemployment. Companies don't need as many workers. Companies aren't looking to hire as many people, so they lay people off, which leads to an increase in unemployment due to a decrease in economic activity. That would seem to jive. That would seem to all flow through. So, but again, this panic of, oh my gosh, there's going to be this second massive bout of inflation, whatever. No, this is the same nonsense that you heard from people when they said that, the same crowd that told you that inflation was transitory. Okay, that my favorite thing, Grandma Janet. Out there, oh, inflation's transitory. Yeah, okay, all right. They also told you that, oh my gosh, Trump's tariffs are going to be the end of the world. They're going to wreck the U.S. economy. They're going to wreck the world economy. They're going to lead to this massive inflation. The same people that told you all that nonsense are the same people pushing this next garbage. And this next massive bout of inflation, it's coming any moment now. It's just around the corner, and you need to buy all this gold. No, I think the reason why gold has shot up the way it has is because of this. It's because of the national debt and the spending. I have always said one of the things, central bankers buy a lot of gold. They've been forcing the gold price up because they've been buying a lot of gold. Now, central bankers have a love-hate relationship with gold. They love gold as an asset. They love gold as a backup. They love to buy gold because they realize that what they've been doing here is wrecking the economy. So you need a fallback, and gold is always that fallback. Okay, so that's that. So they realize that from a practical standpoint, okay? But they also hate gold because the price of gold is a constant reminder. The price of gold, you can think of it theoretically like this. Gold is basically a grade for how central bankers are doing in their job. So if the price of gold is real low, that means there's not a whole lot to worry about. Central bankers are probably doing a pretty good job out there. If the price of gold is at $5,000 an ounce, that would pretty much signal to you that central bankers are doing a lousy job, and that people are highly concerned because they think that the central bankers are about to drive the economy into the toilet. So think about it from that perspective. Like that is a very real thing. So again, like I said, central bankers have this kind of love-hate relationship with gold because on the one hand, they know they need it. They know that it is the ultimate backup and store of value, but they also understand that it's a grade of their performance, in a very real way. How are they performing? What are they doing at their job? So, and then let's take a look at this for a second. So the silver market is messed up. These buyers are feeling the pain. So last week, border police stopped a car crossing from Hong Kong into the neighboring mainland Chinese city of Shenzhen. The suspected crime, silver smuggling. Two men in their 40s hid nearly 500 pounds of silver bars in 10 Danish-style cookie tins 6 milk powder tins, and 9 crispy egg roll boxes. The estimated market value was roughly $782,000, according to Hong Kong customs authorities, who arrested the men and seized the bars and cookies they were hidden under. Oh man, yeah, wish we could have got the cookies there. So the duo were likely headed for one of the largest bullion markets in China, the Shenzhen Shubi gold and jewelry market, hoping to cash in on the biggest silver boom in a generation. The market, where prices trade at a premium compared with other countries, has become an epicenter of a metals mania that has captivated traders around the world. Silver prices have shot up more than 250% in the past year, to as high as $114 a troy ounce in New York trading at their peak. They were up 63% in January alone. In China, where the metal is needed for solar panel production and coveted by speculators, silver futures have risen to even higher levels, above $140 on Thursday. So silver's surge crumbled on Friday when prices plunged more than 30% off their record highs, below $80 a troy ounce. The metal's meteoric rise, analysts say, has been supported less by rising industrial demand or lack of supply, and more by speculators betting on a shifting global order and growing distrust of the U.S. dollar. So yes, I do think there's a lot of trust to that. But yeah, you could just see this absolute shot up and increase in the price of silver. And then on the far right here, you can also see this 30% plunge here, shooting back down to $89 a troy ounce. So again, but we did have, like I said, we did have this bounce back. Let me see here if I can find it. So again, we did have this, despite all of that craziness in the market this weekend. It was a lot of craziness. The Dow bounced back yesterday to hit 50,000, close above 50,000 for the first time. So again, how do we read all this? Well, again, it's a little bit of a stock market, I think, overreaction in some of these things, but we will see how some of this plays out. I do think that the overall for the rest of the year, I think that things will ride out and everything will be fine. I think we probably will see some blips like this, a little bit of ups and downs, depending on the news and what companies do and what happens in crypto markets with crypto legislation and all that stuff I just talked about. So like I said, we'll see how all that plays out the rest of the year. I do think, like I said, I do think this will be fine. I do think things will turn okay. I do not see anything on the rise for some type of massive inflationary bout. But again, it always comes back to that fact of, what speculation is in the gold and silver market, what's going to happen with crypto legislation, and can our government, get our finances under control? Can the government, do something about the massive spending problem? Can they reduce the spending? That's the big questions. If they can, everything else will kind of work itself out, but like I said, it remains to be seen. All right, let's switch gears for a couple minutes here. Let's talk about there was a bunch of big merger news this week. A lot of mergers, a couple of big banking mergers, and then the one big merger outside of banking with XAI. And we'll talk about that in just a second. So Santander basically agreed to buy Webster Financial this week for $12.3 billion. The acquisition would create a top 10 retail and commercial bank in the U.S., buy assets at a top 5 deposit franchise in the Northeast, the bank said Tuesday. So Banco Santander has agreed to acquire Stamford, Connecticut-based Webster Financial Corporation for $12.3 billion in cash and stock. Under the deal's terms, $84 billion asset Webster would become a wholly owned subsidiary of Santander. Christiana Riley will remain Santander's country head in the U.S. and the CEO of Santander Holdings USA, while Webster CEO John, if I'm saying this right, Kiula, maybe it says Kiula, will become the CEO of Santander Bank, into which all of Webster's businesses will be integrated, the company said Tuesday. The deal is expected to close in the second half of the year and awaits regulatory approvals in the U.S. and the European Union. The transaction's price tag tops that of last year's biggest bank deal, which was Fifth Third buying Comerica for $10.9 billion. The Webster acquisition would make Santander a top 10 retail and commercial bank in the U.S. by assets, with about $327 billion in total assets, and a top 5 deposit franchise in the Northeast with about $172 billion in deposits, according to a securities filing. The deal's value represents a 16% premium to Webster's 10-day volume weighted average share price and is about twice Webster's fourth quarter tangible book value. Webster's investors will receive $48.75 in cash and 2.0584 Santander American Depository shares for each Webster common share they own. The total consideration of $75.59 per Webster share is based on the Spanish bank's closing stock price on Monday. And again, as a larger organization, we will unlock greater scale, broader capabilities, and new opportunities for growth while remaining deeply focused on the people who define our success. Yes, so we shall see. But again, a major banking acquisition there. And then we had another one on the smaller side, yet still very important. So New Jersey banks to merge a $597 million deal. Columbia Bank and Northfield Bank will combine to create a bank with $18 billion in assets, bringing Columbia's footprint into New York State for the very first time. Now, Columbia Bank is a very interesting bank in New Jersey. Columbia Bank has basically been what I would call a serial acquirer here in the last few years. They have been gobbling up a bunch of banks, and this is just their latest acquisition. So Columbia Financial will buy Northfield Bancorp in a $597 million transaction meant to create the third largest regional bank based in the Garden State, the holding company said Monday. The Fair Lawn-based Columbia Bank parent and Woodbridge-based Northfield Bank parent will create a bank with $18 billion in combined assets. It will also extend Columbia's footprint into New York for the very first time, with 19% of branches post-merger based in New York City boroughs. Alongside the deal's announcement, Columbia plans to convert to a public company through a plan in which shares of the mutual holding company will be sold at $10 per share, a part of a second step conversion. The combined bank will become a wholly owned subsidiary of a new holding company formed through the transaction. So, and again, this just kind of adds to the interesting part of Columbia Bank's their history of the organization. So they are a mutual holding company. They are not a commercial bank or savings and loan bank or thrift. They are a mutual holding. And in order for a mutual to convert to a commercial bank, they have to go through what's called a second step conversion, which is just a multiple step conversion process, and they have to convert over. So they're going to convert over, complete this merger, then they're going to do an IPO, go public. So again, a lot happening here for Columbia Bank, and I would not suspect in any way, shape, or form that Columbia will be done. I'm sure after they absorb Northfield Bank and let the dust settle on that, and they get through their conversion to a commercial bank and issue their IPO, I'm sure once all that stuff is done, probably throughout the remainder of this year, I would expect that next year they'll be right back on the merger train, looking to probably buy another bank or two and keep on growing, because they, like I said, they've been very busy. The simultaneous merger allows us to immediately leverage a portion of the capital raised and materially augment financial results, Columbia CEO Thomas Kemley said in a prepared statement. Northfield has built an excellent deposit franchise with a conservative credit culture, which makes it an ideal fit with Columbia and provides great opportunities for future growth. Northfield CEO Stephen Klein said he expects the transaction to create value for its customers and stockholders. Under the conversion plan, shares of Columbia common stock held by those other than the mutual holding company will be converted into common stock of the new holding company. Shares held by MHC, which owns roughly 73.1% of Columbia's outstanding common shares, will be canceled. The number of common stock shares issued by the new holding company will be based on the aggregate pro forma market value of the holding company's common stock as determined by an independent appraisal. Northfield will merge into the holding company following the second step conversion, and each outstanding share of Northfield common stock will be converted either to shares of holding company, common stock, or cash. So following the merger, Kemley will be president and CEO of the new holding company and bank. Columbia Chief Banking Officer Dennis Gibney and Columbia CFO Thomas Splain Jr. will retain their roles. Klein will be the Chief Operating Officer for the new holding company and the bank. So this is the second New Jersey bank deal in the past 6 weeks after Red Bank-based Ocean First announced plans in late December to buy Uniondale, New York-based Flushing Financial for $579 million. Ocean First counts 5 branches in the Empire State, but buying Flushing would give it 30 additional locations in New York. So yes, I didn't really talk about, I probably should have given Ocean First, their merger. I probably should have given that a little bit more coverage last week, but I didn't. But it's, again, another kind of important merger in New Jersey. And Ocean First has been a very active acquirer over, the last, 7-8 years. Ocean First has built up quite nicely, bought a number of banks around New Jersey, become one of the largest players in New Jersey, made a little bit of move into Philadelphia, made a bigger move into New York, and that's where they continue to put their focus is on growth in New York. So again, very interesting stuff. And then let's go to the acquisition here. So Elon Musk's 1.25 trillion AI and space mega merger. So the fast track deal is premised on SpaceX's satellite prowess combined with xAI's technology. So Elon Musk took a gulp of water on stage of the World Economic Forum in Switzerland last month and started talking up one of his latest passions, data centers orbiting Earth. So the lowest cost place to put AI will be space, Musk said. That will be true within 2 years or maybe 3. Behind the scenes, the groundwork was already underway for a mega merger of SpaceX and xAI, his artificial intelligence startup, and intends to make the sci-fi vision a reality. Within days, bankers from Morgan Stanley provided an estimated valuation of both companies that could be used to structure a merger, according to people familiar with the matter and investor disclosures viewed by the Wall Street Journal. SpaceX's board decided as of January 30th the company was worth $1 trillion. And xAI's board decided it was worth $250 billion, the document shows. So SpaceX and xAI signed a merger agreement creating a $1.25 trillion company on January 31st. The deal closed 2 days later, making it the biggest corporate tie-up by value in American history. The merger follows a busy year in deal-making from us, from the combination of a social media company X and xAI to Tesla's $2 billion investment in the AI firm. It also promises a windfall for investors in xAI. The billionaire entrepreneur has envisioned making xAI's Grok the most popular artificial intelligence in the world, and building out its capabilities requires a lot of money. And for the startup being hitched to SpaceX ahead of the initial public offering of stock gives it more financial muscle to compete with the likes of OpenAI and Anthropic. However, longtime investors in the satellite builder and rocket operator have had to make room for Musk's AI shareholders, and they face the prospect of supporting an artificial intelligence company through what some believe to be a bubble reminiscent of the dot-com boom and bust. Merging SpaceX and xAI represents a level of risk-taking and ambition that is novel even for Musk. The 1.25 trillion value assigned to the new SpaceX is a bet on Musk's plan for convergence of AI in space. It is also a wager on unproven technology deployed at a vast scale. In a memo sent to employees Monday, Musk said starting launches of AI satellites is the company's immediate focus. SpaceX, xAI, and Musk didn't respond for requests for comments. So, man, this is fascinating. This is really interesting stuff here with just SpaceX and xAI and X. You can't forget about X. I mean, you're throwing a social media platform in the middle of all this stuff at the same time. Here is one of my big concerns here, which this article doesn't really touch on, and I think this is very, very important. Where does SpaceX get all of its money? Oh, that's right. They are funded 100% from government contracts. In other words, they get all their money from taxpayers. The taxpayers have funded SpaceX. So I think a couple people have raised the question of, shouldn't the taxpayer see some type of benefit from the success of SpaceX, given the fact that it is, Uncle Sam that has pumped all the money into SpaceX to make it the successful business that it is. So I think that's a legitimate question. I think that is, I think there does need to be some consideration there. I think the pushback from Elon would probably something along the lines of like, well, yeah, but it's our genius, it's our ingenuity, everything else that has brought this to the forefront, and basically the United States is going to reap all the benefits. We rebuilt what's known again as the space. I mean, man, I tell you what, you go to Florida in 2012, and man, what they call the Space Coast was dead. It was dead. There was nothing going on there. The transformation that Elon and SpaceX has brought to the Space Coast, and just the number of companies that are now there, the people that are employed there. I mean, in Florida, on the Space Coast, in Texas, down obviously Houston, other areas, where obviously SpaceX has their big headquarters and everything over there in Texas. So obviously that, I think that would be his argument on top of that. I'm just saying that I would not be shocked if at some point some politicians and some other people basically start coming back and saying, you know what, Elon, we love you. This is great. No doubt, everything that you said, the merits of it are fine, but big but there. SpaceX is funded 100% through government contracts, and Uncle Sam is footing the bill for all this. And yes, the taxpayers probably should get some kind of benefit back, other than just the overall kind of general economic benefits. Like I said, I'm just saying, I'm just putting that out there. I wouldn't be shocked if that comes up here. I would not be totally shocked if people out there start raising that issue. I'm just saying. So, but okay. And we'll see. We will see. I think the whole concept of, I've been reading a lot about the whole concept of data centers in space. And I find it fascinating. There was this on a sidebar. There was a whole story about this scientist who had basically developed a lot of this technology for how you could put basically a floating data center in space, and how that would transmit data back and forth, and how it would make energy and everything. And this dude, what this guy came up with was so revolutionary that the Chinese were actually trying to like kidnap this dude. It's a wild story. But there's no doubt, and there's another company. Do I have that here somewhere? Yeah, there's another company, Voyager something, and they're working on this, and their big issue is trying to figure out how do you actually cool how do you keep the data, how do you cool the data center in space, which is kind of counterintuitive because obviously space is freezing, but you still have to be able to flow air and stuff through the data. So again, it's some fascinating things to look at, and I'm sure they've got some very brilliant people working on this stuff out there right now. So okay, what do I want to do now? Do I want to continue on with some of this stuff for a minute? I'll tell you what, we will take a step back for a second here. I'm going to go into my usual stuff. I'm going to switch gears here, go into my usual stuff of, we're going to go through economic indicators coming up for this week. I'm also going to tell you guys about the episodes that I put out over this last week. And we're going to get into some general banking news, so which I always do at this part in the program. So hang on, it just needs some sip here. All right, so as you see before you here, let's get into our economic indicators that are coming out this week. So on Monday, February 9th, we have the Fed Waller is going to speak at 1:30. Federal Open Market Committee member Bostic is going to speak at 3:15. On Tuesday, February 10th, we get retail sales Business inventories, Atlanta Fed GDP now for the fourth quarter of 2025. American Petroleum Institute weekly crude oil stock on Wednesday, February 11th. We get the average hourly earnings, the non-farm payrolls, participation rate for January, unemployment rate for January, the 10-year Treasury note auction, the federal budget balance for January. On Thursday, February 12th, we get initial jobless claims, continuing jobless claims, and existing home sales for January. And then finally, on Friday, February 13th, we get the core CPI, CPI for January, and the U.S. Baker Hughes total rate count. So a lot of economic activity out this week. Will we see all that economic activity, those economic indicators? Because with that little mini shutdown thing that I talked about at the beginning, there was a delay in some of the economic data that was supposed to come out this week. So I don't foresee that being an issue. But like I said, when I get back to the articles here in a minute, I will cover that when I have, because I do have a couple articles on some economic indicators and stuff that did come out this week. So I will touch on that here in a few minutes. But all right, so let's go to the episodes that I put out this last week. So on Sunday, this is last Sunday, I did a bonus strategy room episode, which was basically just a cut of the live, which is a cut of the segment from the last week's live stream, which I did an analysis of Kevin Warsh pick as the next Federal Reserve chairman. And so I would tell people, like, if you don't have time to, I like putting out those clips from the strategy room. I put those out. I always call them bonus clips. But I like doing that because, again, there's a lot of people out there, they don't have time to sit there and watch a live stream for 2 hours. Or maybe they can't stay awake watching this live stream for 2 hours. It's probably a better assumption. Again, if you don't have that time, I like putting those clips because a lot of times, a lot of the stuff I talk about goes for 8 minutes, 10 minutes, 15 minutes, and I could clip those and put them into an individual episode and put them out for people. So I did like to do that. And again, just doing the analysis of Kevin Warsh and, was he a good pick? What is his background? What is he hoping to do at the Fed? I kind of cover all that in that bonus episode, that bonus segment. So if you have interest in that, you can go and check it out. And then on Monday, I put out a private credit market update. So the worries on Wall Street about a private credit market meltdown continue to build. BlackRock experiences another fund loss. First Brands founder Patrick James and his brother have been charged with fraud. Ford, GM, and other big names in the auto industry stepped in to help First Brands. Higher scrutiny is being placed on non-depository financial institutions, or NDFIs, and business development companies, also known as BDCs. All this as investors are bailing out in droves, according to the Wall Street Journal. So again, people really like that episode. A lot of nice update on the private credit market and what is going on in there right now. So again, if you have interest in that, check that out. Then on Tuesday, I did my next installment of the crypto series, which was part 34 of the crypto series. And this was titled Tether and Contigo in Venezuela, Bitcoin price drop and other news. So in that episode, we covered 3 stories related to the activities of Contigo, which is a crypto firm, basically in Venezuela and Iran, as I talked about a few minutes earlier in the live stream here. I thought that was really interesting stuff. That whole story about how Tether and this company Contigo were operating in Venezuela and Iran and the stuff they were doing, and like I said, both the good side and the bad side of the situation there, and how the stable coin is being used. And so I go on to say about the description of the episode here. So we consider the duality of stablecoin in those situations. We also examine the recent price decline in Bitcoin. What is driving the price down? In other news, Strategy, the company Strategy, if you follow, Airshake has a lot of money to spend on crypto regulation. Nexo got fined. Wyoming issued its own stablecoin, and an update on Binance. So a lot of interesting thing happening in the crypto series. I will also have another installment of the crypto series coming out this week with even more updated news and info on the crypto world. So again, if that floats your boat, check that out. Then I did an episode that I thought was really interesting. I thought a lot of people would find this interesting. The rise of prediction markets. So Polymarket and Kalshi have exploded onto the scene as prediction markets. These companies have found a way through a legal loophole to compete against DraftKings and FanDuel, two of the largest online gambling platforms. The popularity of prediction markets has caught the eye of Wall Street, with companies such as Goldman Sachs and Susquehanna trying to figure out how they can trade on these new platforms. Coinbase and Robinhood are also adding prediction markets to their platforms as they are competing to become the everything app. Additionally, there is concern that college students and teens could be fueling the growth of prediction markets. Yes. So again, I thought that was a really interesting episode, but that was going out there. And then on Thursday, I did I think an episode that was a little controversial. So why are businesses fleeing Democrat-run cities? So businesses continue to flee Democrat-run cities such as San Jose, Chicago, and New York due to high taxes and regulation. The trend is basically irrefutable at this point. Companies continue to head into states such as Texas and Florida with lower taxes and less burdensome regulations. Democrat cities are in what is called a doom loop in the business world, as the politicians will continue to increase taxes and regulation, driving out business, which will further erode the tax base, increase deficits, and burden the remaining residents. So yeah, I mean, I would be lying or remiss if I said I was a little apprehensive of putting that episode out there, but I just kept seeing all these news and articles about all this stuff going on, and I felt like it kind of got to a point where I couldn't ignore it. It'd become a big enough story that I was like, yeah, I can't really ignore this. And then you look at the number of companies that are, leaving New York, that are, again, I got something. I'm going to read you guys something right here. If I still have this, if this still comes up here. I think I lost it, but can I find it here? Hold on. I'm going to see if I can find this here. I'm not finding it. I'm not seeing it. But basically what it was it was a post from Mondami in New York yesterday, basically saying that, he's like, yeah, if a company tries to leave New York, we're going to go after them. Like we're going to continue to tax them, and wait for it, we may actually try to take over their business. This is insane talk. I mean, I can't even believe that you would be hearing that from any politician or public official in America. I mean, it's like you have no right, like your property rights. You have no right to any. Basically, if the government could just take your business from you, repossess your business property, your intellectual property, like they could pretty much take anything from you. So I mean, it is like, that is highly disturbing to hear something like that. And that's the kind of thing, when I said in that episode about, when I talk about the doom loop, that's exactly what I'm talking about. Like that kind of rhetoric is not going to make companies want to hang around. That is what's going to want them to move even faster. And this idea, this stupid, it really is this stupid idea of, like, oh, well, we'll just go in and take over that company. Oh, will you now? Like, yeah, that's not going to happen. And if the employees were, all that's going to happen is the employees are going to find themselves unemployed at the end of the day, and that business will take its intellectual property, it will take its business, its assets, everything, and it will move to another state, and it will just employ people from that state. That's what will ultimately happen. And like I said, these kind of actions will continue to continue this. And obviously, I did another episode 2 weeks ago. I did an episode called is Texas and Florida going to become the new Wall Street? Obviously, if this new mayor of New York continues down this road he's going down, yes, that is going to happen. Texas and Florida will become the new Wall Street, because all of these companies will flood out of there. Because I talked about in that episode that I did on Texas and Florida becoming the new Wall Street, I basically talked about how, the technology is what has made this possible. Like there are no, I mean, the trading pits and all that stuff that you see on the New York Stock Exchange, that stuff, that's theater. that's theater for CNBC and the American people. That's not real anymore. I mean, all the trading is electronically. It's all done electronically. All the data warehouses that store all the main data for Wall Street, they're all over in New Jersey. They're not in New York. They're not in New York City. They're not in New York State. They're all over in New Jersey. So these stock exchanges can operate from anywhere. They don't need to be in New York anymore. So if New York, if the mayor of New York and Democrats in New York are going to start doing really stupid things, they're going to move. They're going to move and they're going to leave. And that's the reality of what is going to happen. So again, like I said before, I didn't really want to do that episode per se. I just felt like it was becoming an important topic. It's becoming an important issue, and it's just something I had to cover. So, and then finally, yesterday, on Friday, yesterday, the episode I did was while 401ks are making millionaires, there are changes coming. So as 401ks are creating a generation of moderate millionaires, Wall Street is seeking to add new investment options. Some of these options include private assets, alternative assets, crypto, and annuities. Are these investments a good idea? Are these investment products safe for everyday consumers? It is concerning that some of these investments can be difficult to get out of and present higher levels of risk. So again, I thought it was a very interesting episode. I had been following some of the potential changes on the horizon for 401ks. And so I wanted to bring that to people and share that with everyone so that hopefully people could just stay up on this topic. Because obviously, millions, tens of millions of people in the United States have 401ks. And obviously this could, these changes could be very significant and could add a lot of, again, it could change a lot of the risk parameters of how you invest money in your 401k. And like I said, I mean, people need to stay up with that. They cannot, I would repeat that 100 times. They cannot, first of all, let me say, if these investment options become reality, and if this stuff does happen, which I believe it will, if this stuff does happen and comes to fruition, people are going to have to really increase their level of financial education. They're really going to have to understand the risk parameters around some of these investments and how some of this stuff can really hurt them if things go bad. Like, I think private assets, getting into the private credit market, like that's a big one. If the private credit market blows up, what could that do to your 401k plan if you decide to invest in things like that? So again, just, very interesting stuff there. So that was basically the 6 episodes that I put out this week. We got the economic indicators. Now let's get into some of the bank news. So the SEC and the CFTC meet on harmonizing crypto efforts. So I alluded to this a little bit earlier in the live stream. The Securities and Exchange Commission and the Commodity Futures Trading Commission met last week to discuss crypto harmonization between the two agencies. So what were some of the highlights? Well, intermediated trading will continue to play an important role in crypto markets. The CFTC supports lawful innovation in prediction markets. Hello, that's one of the reasons why I did the episode on prediction markets. Regulation by enforcement is dead, and market structure legislation will advance the CFTC's goal of modernizing and future-proofing U.S. markets. Again, very interesting. Under Atkins' crypto asset taxonomy, digital assets, digital collectibles, and digital tools are not securities, even when they are sold as part of an investment contract. See, again, this gets back to what I was talking about earlier about the crypto legislation and the pessimism around that and why that was playing a big role in driving down the price of crypto because of this stuff you're hearing right here. The CFTC will develop rules to deploy additional forms of eligible tokenized collateral and will assess whether an innovation exemption is appropriate. The SEC has provided technical assistance to both houses of Congress as they develop market structure. So, but again, crypto world not happy with a lot of those comments and things coming out. Treasury Secretary Scott Bessent recognizes concerns with stablecoin yield in testimony. So, appearing before the Senate Banking Committee, Treasury Secretary Scott Bessent acknowledged concerns about crypto entities paying interest or yield on payment stablecoins holdings and said Treasury is working to ensure there would be no deposit volatility associated with it. So, while delivering the Financial Stability Oversight Council's annual report to the committee, Bessent said he's been a champion of community banks and wants to avoid any deposit volatility resulting digital asset market structure legislation. So read between the lines there. What that means is that he is in favor of that legislation benefiting banks over crypto and over stablecoin, thus the pessimism, thus the market drop in crypto value. There you go. Producer prices rise in December. Regulators closed Chicago Bank. Yes, I will be doing an episode. So we had the very first bank failure of 2026. So regulators closed Metropolitan Capital Bank and Trust in Chicago and entered into a purchase and assumption agreement with First Independence Bank in Detroit. So Metropolitan Capital Bank had approximately 261 million in total assets, which is kind of interesting. And actually, that one bank failure made the loss was larger than I think a couple. We had a couple small bank failures in 2025. Nothing major there. There was fraud in a couple of those instances, which made some of those cases very interesting. I covered those cases, but again, this one was kind of bigger than both those cases that failed in 2025, making it the largest bank failure since 2024. So again, just kind of some interesting details with that. But I'll be doing an episode on that and covering that coming out this week. Fed finalizes scenarios for the annual stress test. So the Federal Reserve finalized the hypothetical scenarios for its annual stress test for large banks. Indicators we'll talk about in a few minutes. Private sector added 22,000 jobs in January. Service sector economic activity continues to expand in January. Mortgage applications dropped last week. The FFIEC announces updates to liquidity web pages. So that's very interesting. What's called the UBIPR report. So basically, whether a bank is publicly traded or not, you can look up their financials. You can go to the FFIEC website. You can look up what's called the UBIPR report, the Uniform Bank Performance Report. So you can pull a UBIPR on any bank in the country and basically be able to look at their financials, see how they're performing, which again is a very interesting thing. So the FFIEC made some updates to that UBIPR report. Manufacturing activity expands in January. Bank financial officers report tighter standards for commercial and industrial loans. So this is known as the SLOOS, the Senior Loan Officer Opinion Survey from the Federal Reserve. So tighter lending standards for commercial and industrial loans to firms of all sizes, stronger demand for C&I loans to large and middle market firms, and unchanged demand for C&I loans to small firms. Unchanged standards and stronger demand for commercial real estate loans, unchanged lending standards and weaker demand across most categories of residential real estate loans. Standards reportedly eased for auto loans and remained basically unchanged for credit cards and other consumer loans, while demand weakened for auto and other consumer loans, but remained basically unchanged for credit card loans. Independent banker highlights the power of CDFIs. Treasury Secretary Bessent expressed support for community bank regulatory relief. So while delivering the Financial Stability Oversight Council's annual report to the House Financial Services Committee, Bessent said, going forward, regulation and supervision should address material risks, enhance transparency, and reduce unnecessary burdens, particularly for community banks. So SBA announces stricter residency requirements. The Small Business Administration announced it will no longer guarantee loans for small businesses owned by foreign nationals. There you go. And I'd expect probably some more announcements from the SBA as we move forward. Ahead of House vote, ICBA urges support for community bank regulatory relief. ICBA urged members of Congress to pass the Housing for the 21st Century Act and called for grassroots action for community banks ahead of this week's vote. CDFI fund receives full allocation for 2026. The spending bill signed into law this week fully funds the Community Development Financial Institutions Fund for 2026. Washington enacts tax on credit unions that acquire banks. Now, this is Washington State, not to be confused with Washington, D.C. So Washington State recently enacted a tax on credit unions that acquire or merge with a bank. So effective January 1st, 2026, Washington state-based credit unions that acquire a bank are now subject to the state's business and occupation tax of 1.2%. Yeah, I actually like that. I think that's a great idea. I think that a lot of other states around the country should adopt that. I think that's good. ICBA. Latest National Trust Bank Charter application highlights the need for a moratorium. After the latest non-bank entity applied for a National Trust Bank Charter, ICBA reiterated its call for the OCC to pause approvals of pending applications. So following Laser Digital's application to form a National Trust Bank focused on digital assets, ICBA said the OCC should delay approval or substantive consideration of any pending national bank trust charter application until it has finalized the notice of proposed rulemaking concerning the scope of permissible activities for national trust banks under the National Bank Act and corresponding OCC regulations. So yes, we will keep an eye on that. ICBA and others oppose PayPal's ILC application. ICBA attends White House meeting on digital assets. So ICBA and other groups met with administration officials at the White House to discuss concerns with digital assets market structure legislation. ICBA urges OCC to pause approvals of National Trust Bank Charter applications. ICBA urges agencies to streamline the call report. So this is kind of interesting. So ICBA told the federal banking agencies that streamlining the call report is a simple but effective step to reduce the regulatory burdens that weigh on community banks. So this is interesting because there's actually like 3 different types of call reports, and what a bank has to report is different depending on those call reports. I've been searching for somebody. If anybody's watching this, if anybody out there works for a bank or deals with call reports all the time, I'd love to get somebody to come on and basically talk about call reports and just how they work, what's on there, what's important, how maybe difficult or easy is it to get a lot of the information that's needed for the call reports, how some of this stuff has become very burdensome. So yeah, I would love to get that. I've been calling around to a lot of my banking contacts trying to find the right person to come on and address that. So yeah, definitely looking for that. And then finally, ICBA state groups support proposal to recalibrate the CBLR. So ICBA and 45 state banking associations said they strongly report the federal banking agency's proposal to recalibrate the community bank leverage ratio and adjust to the grace period. So yes, so we shall see ultimately what comes with that. So okay, that is my banking news. I just want to check real quick to see if I have anything else. Oh, shout out to new community de novo bank, Cornerstone Community Bank in Owensburg, Kentucky, received conditional approval from the FDIC to form the bank. Bank Slate reported, our good friend of the channel, Paul Davis, over there at Bank Slate. Good job, Paul. So again, shout out to Cornerstone Community Bank. Looks like they are going to get things rolling. Their CEO, Jonathan Lawson, a former chairman and president of Bank of Ohio County, Inc., and Stephen Ford, a former director at Cardinal Savings Bank and First Security Bank of Owensburg, Inc., are among the proposed board members, according to the report. So, hey, good on them. And here's another interesting thing. So, let's see here. So prediction market operator Kalshi seeks margin trading to be added to its platform as it lures institutional investors with sophisticated financial contracts. The Financial Times reported, citing people familiar with the matter. The company has held meetings with the U.S. Commodity Futures Trading Commission over several months to try to win the regulator's approval. So again, very interesting. Again, a lot of interesting things happen with prediction markets. That's why I wanted to do that initial episode, because I know there are more stuff that will be coming in the future there. So let's see here. Anything else I got here? All right, we'll finish that. We'll get back to the articles here with that. So let's go back here. Okay. Let's jump back to credit cards here for a minute. So obviously, In the last couple of weeks, there was this big brouhaha. President Trump coming out saying he wanted to put a cap on credit card rates. So far, it's looking like that has stalled. So the credit card rate cap has stalled, and issuers are doing just fine. The four biggest issuers collected some 146 billion in credit card revenue last year. So you can see the average credit card interest rate here is basically at about 24.5%. So major issuers generated approximately 146 billion in revenue from credit cards last year, a 7% increase from the previous year. So the biggest credit card issuers, again, collected 146 billion. The combined results from JP Morgan Chase, American Express, Capital One, and Citigroup represent the money machine that could be at risk if the Trump administration continues to push for a federal cap on credit card interest rates. Credit card revenue, which includes interest and other fees from consumers and swipe fees collected from merchants, was up 7% in 2025 from a year earlier. The effort has stalled in Washington because of meager support in Congress and a fierce lobbying effort by the banking industry. Treasury Secretary Scott Bessent suggested the administration was still pursuing the idea when lawmakers questioned him about a potential rate cap during a hearing Wednesday. Banks say even a one-year interest rate cap of 10% on credit card balances would disrupt a key business line that helps fuel consumer spending, which drives 70% of U.S. economic growth. Fourth quarter earnings from card issuers and payment networks suggest that high interest rates haven't yet caused people to pull back their card usage. Average monthly revolving balances industry-wide rose by 10 billion to roughly 660 billion in the third quarter. The average interest rate assessed on credit cards lingered above 24% for more than a year. Now, again, this is after credit card rate or after interest rates have decreased, have come down. And credit card companies have remained very high at 24% for more than a year. Banks said they aren't yet seeing signs that consumers are stressed. In the fourth quarter, major issuers reported steady delinquency and charge-off rates alongside continuing growth in card spending and transactions. And again, you can see here annual credit card revenue for American Express, obviously up, Capital One up, JP Morgan Chase up, Citigroup up. So again, this whole thing is very interesting. So obviously, credit card providers are doing just fine. They are making a ton of money right now. The consumer, while again is okay, but I would take us back. Let's go back here to our debt chart here. And again, the total credit card debt is over $1.3 trillion per credit card holder. That equates to $8,178 per average credit card holder. So again, I think you go back to that and you go, okay, you go back to that and you say, okay, well, yeah, okay, they're maybe hanging in there, but they're certainly not doing great. And again, again, a lot of the interest rate cap stuff, I think, is bluster by the banking industry. Like, oh my gosh, the world will collapse if you cap our interest rate at 10%. Oh my gosh, the world's gonna. No, I mean, they're still going to make a ton of money. They're just not going to make as much money as they're making now. But they're still going to make a ton of money. And this idea that they're just going to start, cutting off people's credit lines and they're not going to offer credit to people. I mean, it's absurd. It's absurd. That's not going to happen. And again, look, I can appreciate them wanting to, protect their moneymaker. I get it. But I also said this. I also said that this was going to be fascinating because obviously capping 10% on credit cards would be incredibly popular amongst consumers. No doubt. Consumers would find this incredibly popular. However, I said that the politicians in DC this would be a real dilemma for them because while they, certainly want to do something positive for their constituents, they get a lot of money from the banking lobby. And the banking lobby went into overdrive here. And you could see why this stalled and why a lot of the politicians were like, yeah, I get a lot of money from JP Morgan. So, yeah, I don't really want to do something that's going to make them mad and not, fund my reelection campaign. So, so again, you see the really interesting kind of dynamics of this argument and what is playing out here and what is going on. So, Do I think that this rate cap thing, this probably, honestly, probably gets dropped because, in other words, we're in a midterm election year. Um, Again, this would be something that would be very popular with consumers, no doubt, but it's going to get a lot of the politicians in trouble with, unfortunately, the banking lobby. And a lot of these politicians that are trying to get reelected, I'm sure there's a lot of Republicans out there running back to the president going, "Oh, Mr. President, please don't do this. Don't do this. I need to get money to get reelected and all this other stuff. And this could hurt us in the midterms. And we have a razor thin margin as it is, and blah, blah, blah." So I'm sure, the president is hearing all that right now in his ear. So again, just a very interesting thing to keep an eye on. I just wanted to point this out. But let's keep rolling here. Now, let's get into some Epstein stuff here for a second. Now, obviously, everybody, all this Epstein stuff has come out here, and there's just a couple things that I wanted to point out. Paul Weiss, the chairman of Brad Karp, he resigned after Jeffrey Epstein email disclosure. So Brad Karp, the chairman of major law firm Paul Weiss, resigned. That post after fallout over emails between him and Epstein were made public. Karp said recent reporting has created a distraction that has placed a focus on me that is not in the best interest of the firm. Really? Pretty much he had a mutiny that basically when this stuff came out, all the main players on the board were basically like, "Yeah, dude, you got to go." Scott Barchet, who has been chair of Paul Weiss corporate department, was appointed chair of the firm effective immediately. So yes, Brad Karp, he got this dude right here. He got the heave ho after all his relationship with Jeffrey Epstein was disclosed. And I would tell people why am I'm covering this, because I believe this is the first of many scalps to come forth with this. Now, let's take a look at the next one. I've reported on this one already. Catherine Rumler, the chief lawyer for Goldman Sachs, she's got a major problem. So when the FBI arrested Epstein, he called Catherine Rumler. Now, why is this? Well, Catherine Rumler, in a previous life, she was known as the fixer for the Obama White House. That's why Epstein called her. But she had a long relationship with Epstein, and I am really amazed that she still has a job this week. I really am. But she is now the top lawyer for Goldman Sachs. She consulted Epstein on a relationship and potential new jobs while delivering legal and media advice. So again, I'm not going to go through this whole thing in here, but I'm just saying that this is causing, and this is going to, the whole Epstein issue is causing, and it's going to continue to cause problems for many people in the business world, many high up, powerful people in the business world. And like I said, I point this out because again, I wouldn't be surprised if Kathy here is gone in the next week or so. Something is obviously happening, I would believe, behind the scenes. And I'm sure she is fighting tooth and nail to keep her job right now. And I'm sure there are probably people, maybe there's some people that are defending her, and maybe there's some people that want her gone. But we, we'll see how this whole thing plays out. But I am going to continue to follow this as these scalps continue to come down. I will let people know. So there's that. So, okay. And then, Trump had this major announcement this week, the launch of Trump RX, which was a website for discount pharmaceutical drugs. The president addressed the nation to unveil a new direct from manufacturing price savings option for Americans. So I thought this was pretty cool. So President Donald Trump addressed the nation on Thursday night to announce the launch of TrumpRx.gov, featuring medicine and discount prices. This launch represents the largest reduction in prescription drug prices in history by many, many times, Trump said. The president said Americans no longer subsidize drug costs for the rest of the world. Well, maybe. So again, he launches this Trump RX website, and hopefully get discounted pharmaceutical drugs, and we'll see. Hopefully this is a good thing. I hope it is, but we'll see how this thing plays out over time. All right, now I talked about this a couple minutes ago. So the jobs data with this little kind of mini government shutdown that we had for a few days. So the jobs data delayed. Analysts are flocking to unofficial data. So countless private firms offer a read on the job market, consumers, and the economy, but they can't replace official government statistics. Economy watchers are once again turning to a patchwork of unofficial data after another federal spending impasse pushed back the release of official government figures. The partial government shutdown that ended Tuesday forced the Bureau of Labor Statistics to delay its January jobs report, originally scheduled for Friday, until Wednesday of next week. January inflation data, which had been scheduled for next Wednesday, will move back 2 days to next Friday instead. In the interim, the public is looking at all kinds of other things. Digging into a mosaic of surveys, data sets, and indicators from private sources, starting with a monthly jobs report from payroll processor ADP released Wednesday morning. This showed that the economy added just 22,000 private sector jobs last month. ADP also substantially lowered its employment estimates for 2024 and 2025. So like I said, so unfortunately, we got some of this data got delayed. It got pushed back. So now let's look at a couple of other economic indicators or things that did come out this week. So like I just said, private payrolls rose by just 22,000 in January, far short of expectations, according to ADP. Private companies added just 22,000 positions for January. The total was less than the downwardly revised 37,000 increase in December and below the consensus forecast for 45,000. The report stated 2020 starts 2026 off on a basically the same note where 2025 ended, a lackluster job market in a low hire, low fire environment. So the U.S. labor market barely budged in January, with hiring below even muted expectations, according to a report Wednesday from payroll processing firm ADP. Private companies added just 22,000 positions for the month, and the number would have been negative had it not been for a surge of 74,000 hires in the education and health services category. The total was less than downwardly revised 37,000 increase in December and below the Dow Jones consensus forecast for 45,000. So, okay, and then we go to layoffs. So layoffs in January were the highest to start a year since 2009, according to Challenger. U.S. employers announced 108,435 layoffs for the month, up 118% from the same period a year ago and 205% from December of 2025. The total marked the highest for any January since 2009. At the same time, companies announced just 5,306 new hires, also the lowest January since 2009, which is when Challenger Grain Christmas began tracking such data. Also, job openings fell sharply in December to 6.54 million, to their lowest since September of 2020. Available jobs are down by more than 900,000 just since October. So yes, so the job market is, again, not horrific, but not looking fantastic at the moment either. But hey, look, I would also point out to people too that look, it is common for companies to lay off in January. This is not uncommon, and I'm certainly not going to push the panic button because January was a little soft and not so hot. I think you got to wait and see what is February, March, April, and May. What do the next 3 or 4 months look like? Because again, like I said, it's very typical for a lot of companies to, especially hospitality, retail, they hire a lot of employees in the fourth quarter to basically, gear up for the holiday season. And then after the holiday season is over, they lay a whole bunch of people off. So again, a lot of this stuff is not unheard of for this time of year. Are the numbers a little low? Yes, absolutely. Certainly a little low for what we like. But again, I'm not ready to push the panic button yet. We'll see. We will see when we get the jobs report number, the official jobs report number this week. We'll see what happens. We'll see what comes out with all this. So, all right, and then going on now, this a little bit of bright news. So U.S. factory output rises to a near 4-year high as manufacturing rebounds. So 2 manufacturing surveys point to improved business conditions and stronger factory activity at the start of 2026. So U.S. manufacturing gained fresh momentum in January as factoring output increased and business conditions improved, according to survey data released on February 2nd, offering the clearest sign yet of a turnaround after months of weakness. The Institute for Supply Management its headline measure of U.S. manufacturing activity hit its highest level since August of 2022. And S&P Global data showed that output at U.S. Factories grew at its fastest pace since May of 2022. Together, the surveys point to a broad-based improvement in manufacturing activity at the start of 2026 after months of mixed readings marked by sluggish growth and bouts of contraction. So again, good information here. Output increases, demand is still a little uneven, but ISM shows rebound but flags cost pressures. So again, good, but I think overall a positive report here on manufacturing. So we'll keep an eye on that. Okay, and then December commercial real estate deal volume sinks further, but office is a surprising bright spot. So commercial real estate deal volume dropped 20% in December, year over year, the second straight month of declines, according to monthly data provided by Moody's as a media exclusive to CNBC's Property Play. For all of 2025, deal volume was 17% higher compared with 2024, a healthy expansion, but lower than the year before. The recovery in office has been swelling as return to office orders and a boom in AI employment counter the pandemic-driven narrative that office is over. So again, let's see here. The U.S. commercial real estate market in 2025 was defined by a steady, albeit decelerating, climb towards stabilization, said Kevin Fagan, head of CRE Capital Markets Research at Moody's. The recovery proved resilient in the face of significant economic slowing, policy uncertainty, a massive loan maturity wall, and persistently high interest rates compared to 3 years ago. Leading the landscape were the multifamily and office sectors. The recovery in office has been swelling as return to office orders and a boom in AI employment counter the pandemic-driven narrative that office is over. Total office deal volume was up 21% in 2025 compared with the year before. Investors, however, continue to favor Class A or trophy assets as the rest of the market struggles. Multifamily, which has been seeing declining fundamentals such as occupancy and rent, still led 2025 deal making up 24% in deal volume from 2024. It benefited from higher mortgage rates in the single family for sale market, which kept more renters from becoming buyers. Retail also saw a healthy gain of 19%. Fundamentals in the sector, especially grocery anchored and necessity-based centers, were strong, fending off continued pressure from e-commerce. Retail has officially re-entered the conversation as a durable investment-grade asset class, with investors more focused on the usual underwriting nuances than potential functional obsolescence and a retail apocalypse, Fagan said. I just wanted to see if they had anything here on industrial. Don't see anything really there on industrial, but okay. And then all right, now let's shift gears for a minute. I wanted to show everybody. So we know about interest rates in the US, but what are some of the interest rates in other countries around the world? So the Bank of Mexico decided to pause its rate cutting cycle. The Board of Governors voted unanimously to leave overnight interest rates target at 7%. So Mexico City, the Bank of Mexico left its benchmark interest rate unchanged Thursday, pausing after 12 consecutive cuts to assess the inflationary impact of recent tax and tariff increases. The 5-member Board of Governors voted unanimously to leave the overnight interest rate target at 7% in their first monetary policy meeting of the year. The pause was widely expected. The board deemed appropriate on this occasion to pause the rate cutting cycle consistent with the assessment of the current inflationary outlook. The central bank said the decision took into account the upward revision in the central bank's inflation forecast and the need to continue evaluating the impact of the fiscal adjustments implemented at the beginning of the year. So that is Mexico. And then let's take a look at the Bank of England and the European Central Bank, the ECB. They hold rates with future easing as a wild card. UK Central Bank indicates another cut could follow in the coming months. So the Bank of England and the European Central Bank kept interest rates unchanged Thursday, but different outlooks for inflation are likely to send policymakers in different directions in 2026. So the key point, the UK Central Bank left its key rate at 3.75%, and the ECB kept its main deposit rate at 2%. Both moves were widely expected by investors. central banks in the developed world are largely nearing the end of their rate cutting cycles as the post-pandemic surge in inflation retreats and global growth improves. But a number of uncertainties are leading policymakers around the world to diverge. The BOE said Thursday its key rate could fall further this year, and the central bank lowered its forecasts for growth and inflation. All going well, there should be scope for some further reductions this year. The Federal Reserve also held rates steady last week. The ECB isn't expected to cut rates at all this year after pausing its most aggressive rate cutting campaign since the global financial crisis in June of 2025. Meanwhile, Australia's central bank earlier in the week raised interest rates for the first time since 2023 and admitted it got inflation forecast badly wrong. So I just want to point out here the one key thing that you read here through all of this, through the Bank of England, the European Central Bank, through Australia, and through Mexico, is that they were all on aggressive rate cutting campaigns. They aggressively cut interest rates. Meanwhile, our Federal Reserve, Jeremy Powell, because he was playing politics, basically, refused to lower interest rates until finally, he hid behind inflation and tariffs and everything else, every boogeyman he could come up with, until finally, toward the end of last year, he had no choice but to start reducing rates. He's gone back to his stubborn ways again, and probably will do his best not to decrease interest rates again until after he's gone in May. But we'll see. But again, I just want to point out that while our central bank was basically sitting there doing nothing for over a year, that every other central bank around the world was cutting interest rates like crazy. So again, just wanted to point that out, just to show everybody what other central banks are busy doing around the world right now. So okay. This is kind of interesting, and I wanted to point this out very quickly. So we have this issue here: U.S. lawmakers weigh visa restrictions and sanctions on EU over alleged censorship. They are also examining the Granite Act as possible counter to EU laws. Then we also have here: EU orders TikTok to fix apps' addictive design. EU regulators warn TikTok it must curb addictive features like infinite scroll and autoplay that could harm the physical and mental well-being of its users. So we are running into a big issue here where Europe and the UK are really trying to censor a lot of the social media apps. You just had this whole issue in France with the France authorities raiding the office of X in France, which is completely absurd. But they are, the EU and Europe, Australia, and you're also starting to see, like Australia, they just basically clamp down on anyone under the age of 16. Spain is also doing the same thing. They are also targeting anyone under the age of 16 and being able to get on social media apps. But what you're really seeing is this real clampdown on free speech. And I think that the backlash of this could come in the form of tariffs. And I say that because I think we could see this reigniting of the tariff debate over this stuff. And that's why I wanted to point this out. Again, I think the more that Europe tries to infringe upon our free speech here in America, the more, President Trump is going to be apt to, really push back on this with tariffs and tariff action. And it's really could affect the trade deals that have been struck. So like I said, just wanted to point this out. All right, let's get into some trade news here for just a couple minutes. So the American and Chinese economies are hurtling toward a messy divorce. The breakup is focused on sensitive matters now considered national security issues, including semiconductors, food, and energy. So yes, I think that we are in the very early stages of beginning to see this decoupling from China. And again, and this is going to have a lot of implications again for both the U.S. and China. So, we'll keep an eye on that. But again, I no doubt that a lot of these issues are national security issues. I mean, semiconductors, food and energy, and pharmaceutical drugs. I mean, these are all national security issues. And I've said it for a long time. We have gone too far in basically outsourcing everything to the point of having utter dependence on China for all of this stuff, which is insane. And so we have to reverse a lot of that. We also have to bring manufacturing back to the U.S. We have to bring manufacturing jobs to help the middle class, and reestablish our manufacturing base in the country. So there's a lot of things we have to do there that aren't going to be, and also we are dealing with this basic what I would call a silent war with China, an economic war with China. And so we have all of these things going on here that makes this a very dynamic situation. But let's take a look at a couple other things here real quick. So Trump launches a $12 billion Project Vault critical minerals stockpile. It follows through on the administration's plan to establish price floors for critical minerals, protecting the supply chain from Beijing's predatory pricing. So President Donald Trump announced on February 2nd a new strategic private sector critical minerals stockpile. Project Vault is being seeded with $1.67 billion in private capital and a $10 billion loan from the U.S. Export-Import Bank. And it is meant to insulate U.S. industries from market disruptions such as the seismic critical minerals rule change Beijing previewed in 2025. The Pentagon already has a critical mineral stockpile kept in 6 locations across the country to be used in the event of a national emergency. However, Beijing announced a major rule change in 2025 that would subject all sales of critical minerals mined or processed in China, which could be up to 90% of global supply, to review and approval from Chinese authorities. So yes, a good move here. And then following right on that, the U.S. creates critical minerals preferential trade zone. So the State Department hosted dozens of countries at the first critical minerals ministry on February 4th. The United States hosted more than 55 countries at the first critical minerals ministry on February 4th, announcing the creation of a preferential trade zone meant to offer members predictable and stable conditions for re-entering the industry. During the opening speeches, much mention was made of the leverage Beijing wielded in 2025 when it threatened to subject the world's supply to Chinese regime approval on a case-by-case basis, but officials did not mention China by name. Participants represented some 2/3 of the world's gross domestic product, according to Vice President J.D. Vance. Not all participants had joined as members. Interior Secretary Doug Burgum said on February 3rd that 11 countries had signed on and 20 more expressed interest in joining. The State Department did not release a list of participants or members. So yes, so again, very good news there. So Trump orders 25% tariffs on nations trading with Iran. The president cited national security concerns while imposing the levies, following through on threats made in January. Then we go to the U.S. and Argentina finalize a trade agreement. The deal includes a major expansion of the volume of Argentine beef entering the U.S. Again, great. That's great to hear. U.S. unveils interim trade framework with India and drops punitive tariff. India agreed to buy $500 billion in U.S. energy, precious metals, coal, and other products as part of the agreement. So President Donald Trump removed a 25% punitive tariff on all imports from India over its purchases of Russian oil, the White House announced Friday. The interim agreement between the United States and India will represent a historic milestone in our country's partnership, demonstrating a common commitment to reciprocal and balanced trade based on mutual interest and concrete outcomes, the two countries said in a joint statement. Trump agreed to slash U.S. tariffs on Indian goods to 18% from 50% in exchange for India halting its purchases of Russian oil and opening markets to American goods. India was buying about 1/3, almost 1.215 million barrels per day of its total oil imports from Russia, the country's top supplier of crude. But there is another aspect of this, the whole kind of H-1B visa. I don't have it around me. I did have another story which I did want to talk about with this, but I'll probably save that for next week. But again, President Trump opening up a lot more visas, to India, and I don't think that's going to go over well with his base. I'm just saying that I don't think that's going to sit well. But again, still pretty much good news that at least they've come to this. India and U.S. have at least come to this initial agreement to kind of work out a better trade deal, which is good. And then I think finally on the trade front, Trump extends Africa free trade agreement, easing tariff fears amid tensions. So the deal between the United States and 32 African nations has been renewed until the end of the year, despite strained relations with South Africa and Nigeria. So U.S. President Donald Trump signed a law on Tuesday extending a free trade agreement for some African nations until the end of the year. U.S. Trade Representative Jamison Greer said his department would work alongside Congress this year to update the program to align with Trump's America First policy by expanding market access for U.S. businesses, farmers, and ranchers. The African Growth and Opportunity Act, also known as the AGOA, established under President Clinton in 2000 to provide duty-free access to U.S. markets for eligible sub-Saharan African countries for thousands of products, expired in September, jeopardizing hundreds of thousands of African jobs. The U.S. House of Representatives passed legislation in January to extend the law for 3 years, but the Senate later limited the extension to 1 year, which the House concurred with. The agreement has also been backdated until last September when it expires. So, but still extended through the end of the year, gives them more time to work on another deal. So that's good. So again, for the for the most part, a lot of really positive trade news this week. All right, and then I think I will end here. Last couple stories. So U.S. companies. This is kind of some labor market stories here. So U.S. companies are still slashing jobs to reverse pandemic hiring boom. So many corporations binged on labor during the pandemic and are now facing economic uncertainty and threats from AI. So they are slimming down. So a new era of corporate cost cutting is hitting American workers with full force. Big companies from Amazon to UPS are slashing jobs, looking to shrink their headcounts after years of breakneck growth. Companies generously expanded their workforces during the pandemic years of 2020 and 2021 and doled out hefty raises, worried that moving too slowly might leave them with a shortage of skilled workers. Now, some companies say their hiring sprees went too far. Their biggest concerns today are bloat and runaway expenses. A lot of these companies found that they are just too big. So, and again, Amazon said it would lay off another 16,000 people after laying off 14,000 in the fall. UPS said expected to slash 30,000 jobs. So you are seeing definitely some layoffs from these companies. And like I said, and I think a big part of it was just them overhiring after COVID. And then I think this is the last thing. Yeah, this is the last thing. So the new red flags on hiring emerge as the job market shifts. So job seekers waited a median 83 days for offers by late 2025. 90% of job seekers reported being ghosted after interviews. 90%. That's crazy. 38% of employers reduced entry-level hiring due to AI tools. So again, just some things I wanted to point out there, some things that are happening out there in the jobs market. So, all right. So I'm going to enter into wrap up mode here real quick. So let's go to some of my plugs. So, and hold on. Let me get my banners. Where are my banners at? Let me get my banners. All right. Okay, so if anybody is watching or listening, I should say, on Apple Podcasts or Spotify, please be sure to leave me some positive reviews, as that would really help the channel. I'd really appreciate that. Make sure to visit our website, the bankernextdoor.com. Got some good stuff up there on the website. You could look up any of the past episodes, live streams, I've got blog posts, got all kinds of other stuff up there. So please go check out the website whenever you get a chance. Make sure to subscribe on YouTube for the latest updates. Like today, the live stream here this afternoon is a perfect example. I had at the last minute, I had to kind of change up my schedule for the day, and I had to move the live stream from tonight to this afternoon. I put a post out on YouTube basically saying that. So again, if you want the latest kind of updates on that, make sure to subscribe on YouTube. You can send comments and questions or topic recommendations to info@thebankernextdoor.com. If you want to reach me, there's the email address, info@thebankernextdoor.com. I always love to hear people's questions and comments. And like I said, if you have a topic recommendation, please let me know. You can follow me on social media. You can follow me. I am on Getter, True Social, and X. I do tell people I spend probably the most of my time on X, but you can follow me on there. And as always, make sure to remember that the BND Strategy Room live stream is on YouTube. It will be coming to other platforms here in the next couple of months. I know I've been saying that for a while, but it is happening. But the Banker Next Door, I put out new episodes on YouTube, Rumble, and all major podcast platforms Monday through Friday at 12 noon every day. And you can, like I said, most of the time you can catch the BND Strategy Room live on Saturday nights at 8 p.m. here on YouTube. So again, I appreciate everybody out there. With everybody listening and following, it means a lot to me, and it obviously helps the channel. So, okay, so let's go into wrap up mode. So, what is our quote of the week? So, this quote comes to us from Napoleon Bonaparte. So, it is only by prudence, wisdom, and dexterity that great ends are attained and obstacles are overcome. And that comes from Napoleon Bonaparte. And then finally, what is our story of the week? So I actually, you know what? I'm actually going to bring, hang on a second. I'm actually going to bring something back up here because I wanted to use this to kind of show everybody. So I've been talking the last couple of weeks, I've been talking about yield curves. So I wanted to show everybody a couple of things here. So in this chart right here, here's an example of a normal, this is a normal yield curve, and this is an inverted yield curve. Now, what I don't like this, if you know a lot about statistics and everything, you're going to look at that and say, oh, okay, there's my X and Y axis, and I see the curvature or whatever, like, you know, but for most people, they look at this and it's like, all right, well, what does that mean? What does that really tell me? And so I like to go to this other chart here, just to kind of the Federal Reserve, the Fred index does the spread between the 2-year and the 10-year, which does make up the yield curve. I think that it's much easier to interpret this. So here at the bottom, you have zero line, baseline. So if it falls below zero into the red, it's inverted. If it's above, obviously see as if the yield curve is increasing here in the blue, that's usually a positive sloping yield curve, or what we would call a normal yield curve. But if it's down in the red, if it's heading downward, that would be an inverted yield curve. So hopefully that helps a little bit here. And now I'm going to read. So like I said, last couple of weeks I did. First, I started with Treasury yield. So I talked about Treasury yield. Then I talked about yield curve. Then last week I did yield curve control. And so this week I'm doing inverted yield curve. So an inverted yield curve, which again, you can see it on the screen there in the red on the chart, that would be inverted. So, but like I said here, an inverted yield curve represents a situation in which long-term debt instruments have a lower yield than short-term debt instruments of the same quality. An inverted yield curve is sometimes referred to as a negative yield curve. The yield curve graphically represents yields on similar bonds across a variety of maturities. It is also known as the term structure of interest rates. A normal yield curve slopes upward, reflecting the fact that short-term interest rates are usually lower than long-term rates. This is a result of increased risk and liquidity premiums for longer-term investments, meaning longer-term out on the curve. An inverted yield curve happens when the bond world turns upside down, and bills, notes, or bonds with shorter maturity have higher yields than bonds with longer maturity, which most recently happened in the fall of last year. Well, not in the fall of last year, but basically 2024 running into 2025. Investors and the Fed pay careful attention when the bond yield curve flattens, which we are seeing in the US and elsewhere. On a rare occasion, when the curve does flip or invert, as we started to see in Japan and parts of Europe, that was actually from a couple years ago. That was regularly predicted. That has regularly predicted a coming recession, usually within a year. That most recently occurred during the COVID-19 crisis in the U.S., which went into a 2-month recession starting in February. So again, that's just some of the. So in other words, what that meant there at the end is that an inverted yield curve 95% of the time is a strong predictor of a coming recession, which usually comes 6 to 12 months after the yield curve has reverted to positive territory. So that's usually what that is. So when you see an inverted yield curve, just remember it's a bad thing. It's not a good thing. You don't like to see it happen, because usually what happens is after you come out of that inversion and you return to the normal yield curve, usually a recession is not too far behind it. So like I said, it's not 100% predictor, but it's like a 90-95% percent predictor. So, but okay, that is our inverted yield curve. That is our story of the week. So, so with that being said, I thank you guys so much for hanging out with me on a Saturday afternoon. Hopefully next week we'll be back to our normal time of 8 o'clock on Saturday night. But I hope everybody has a great weekend out there. Enjoy the Super Bowl. Be safe out there. And like I said, I just thank everyone for listening and for watching. I really appreciate it. And like I said, just have a great weekend, and I'll see everybody again next week.